Good morning and good afternoon. Welcome to the Cipher webinar on preparation and readiness, how to proactively manage patent risk. I'm Nigel Schweitzer, the CEO and one of the co-founders at Cipher. More importantly for today, I'm joined by Casper and by Stuart. Maybe you just briefly introduce yourself and the cat.
Thanks, Nigel. Yeah, Cheeto. This is Cheeto. He has absolutely impeccable timing. My name's Casper Gorski. I'm pleasure to be here with you all and present as head of risk the Cipher method, how to proactively manage your patent risk. Probably pretty obvious, but I help our clients do everything from taxonomy creation, classifier building, and then also some of our more advanced solutions such as portfolio optimization.
Stuart?
I'm Stuart Hall. I sit with Casper within that risk solutions group that he was just describing, and I work with Cipher's tools and data to support our clients in really getting insight into some of these risk problems that we'll be talking about today.
Cool. Well, to go and give the listeners some idea of the journey we're going to travel through in the next hour, I'll just briefly introduce the Cipher report. It was co-authored by Francesca Lavoie, who's also my co-host on the Cipher Vision podcast. We'll talk a little bit about that. Casper will explain the frameworks and methodology we use to understand and categorize patent risk, but the bulk of the webinar is a sort of how-to guide, how to manage NPE risk, how to manage OPCO risk. That's where the meat is. We've left lots of time for Q&A at the end, but I do encourage you to ask questions as we go along. So, to the report. I haven't tried to go and summarize what is quite a detailed report, but as I mentioned before, available for download. But here are three of the punchy key findings that I think drive Cipher to do what it does for our customers. The first one is that you all face patent risk. 81% believe that they'll face patent risk in the next 2 years. So that makes it virtually inevitable. The second data point on there I find more troubling, that 56% of patent owners report that they only tell the executive suite when there's a significant issue. So that's a theme we'll come to over and over, that patent risk seems to be managed only when there's a fire, or at least only communicated when there's a fire, as opposed to investing heavily in communicating the benefit of fire extinguishers. The next slide is, well, if they're not communicating, why? And the problems are ranked there. All the underlying data is in the report. But the top two are absence of objective and reliable data and lack of understanding of patents at board level. And I somewhat feel that those findings are connected. The executives will only respond to evidence. That's our whole mantra at Cipher, evidence-based decisions. So if you don't have the data available, then you've got nothing to present to the board, and the board never understand. But it's not the board's fault. It's definitely the job of the IP community to communicate more, often, and better. And we believe better data is a valuable component to that particular solution. Which brings us to portfolios. Many of the listeners come from major corporates. We've looked through the list. We welcome you all. Some are subscribers, some are not, some are prospects. But you all have one thing in common. 92% of you believe that a strong portfolio is a primary approach to risk mitigation, but only part of a holistic risk strategy. So when we talk about portfolio optimization, we're not claiming that's the only tool in your box, but we definitely think it's a very important part of patent strategy. So let's turn over to the substance of this. Casper, maybe you can introduce the framework.
Thanks, Nigel. I think that report was both reassuring reading in the belief of patent portfolios, but also a little bit scary. I think it's time to address patent risk head on as something that's inevitable that all IP departments face. And I think it's a choice about how you manage it. I think definitely the data helps support the quantification, mitigation, and most importantly, the communication of that risk. Here we're looking at the 5 different types, and I think it's important that every IP professional is familiar with all of these. This comes from the brilliant book by Suzanne Harrison, Edison in the Boardroom. I'll briefly talk about the sort of 3 outstanding types of risk, and then the ones which we at Cipher can really help address. Environmental, of course, is any changes in patent law around the world. Innovation risk is the inherent uncertainty of bringing a new product to market. And then the intrinsic risk, the reality that not every granted patent is valid and enforceable. However, we definitely want to talk about in this webinar the infringement risk that's faced by companies, and that's the NPE risk and the assertion risk that we've highlighted here.
One of the things which was evident was the lack of frameworks, and it's not really comfortable for IP professionals to try and quantify patent risk. It's really hard to go and predict the future, as we often say, but severity and likelihood matrices are used across the business in many other areas. And certainly we found support for the fact that the business likes to listen to risk sort of calibration, if I can call it that, by looking at likelihood and severity. So if you understand these various categories of risk, whether it be assertion, environmental, NPE, intrinsic, you can plot them onto a grid. So once you understand how important that risk, if it's rare and negligible, probably not going to take up management time talking about it. Clearly, if it's rare and catastrophic, you might. That's the black swan event we talk about in the report. I think these risk frameworks also work at a more granular level. When you're talking about assertion risk, you can then, as Casper and Stuart will go on to talk about, when you're talking about threats, you can look at the nature of different threats so that you're focusing the effort on the right area. So a useful tool for honing in on what's important. And that, of course, will be different by sector, but it will also be different by business unit within the very varied business groups that are amongst the companies that are listening in today.
I think talking about tools, I can't help but not promo our newest one, which is the Universal Technology Taxonomy. It's been completely instrumental in allowing us to put on this webinar. As you're going to see in the following slides, we've done this worked example using the UTT, as we funnily call it here at Cipher. And here on the screen, you can see the schema. This is 114 categories, and it classifies all patent families in the world into one of these categories, and it's integral into the ability of Cipher to deliver you actionable insights on your patent portfolio. I've got another two examples here on the screen. So on the left, we can see how you might be able to assess a company's portfolio very quickly. We're looking at Microsoft here, and the UTT has been asked to classify its portfolio. And then also the FAMGA group. So really not a trivial task for a system to be able to do, and to give you this insight into, almost 100,000 patent families very, very quickly. I really think this is a great tool in our arsenal amongst many others that Cipher is capable of as well. So how exactly do we use these tools? I think using, Nigel, your report, and also speaking constantly to our customers and developing our solutions, the framework we want to lay out for risk management is in the following 4 steps. Is scoping your technology, so that's building a portfolio of classifiers, or perhaps using some of our pre-built like the UTT. Scoping your threats, both known and unknown. Classifying, so finding all the patents in the world that read onto your organization, projecting through the lens of classifiers onto the IP landscape to find everything that's relevant to you. Getting a manageable threat list, and then modeling those threats that are out there in a quantifiable way that is also easily able to be interrogated by you and others to communicate your risk. And then finally, of course, go and talk to your company, go and talk to your C-suite, your GC, whoever it might be, about the risk you face, and start communicating that as clearly as you can. The first risk I think we want to talk about is a proactive strategy in NPE risk. Of course, we have the sale of a large amount of BlackBerry assets hot on our minds. We're not sure where that's going to fall, but sales to NPEs have increased over time, and it's a very real threat for the vast majority of companies. So it's important to do this proactive step to assess, manage, and mitigate risk. You can see on the screen here some of our suggested ways of mitigation, such as lot network, RPX, IP insurance, and then also proactively buying assets when they come up on market. What we're going to do next is we have this anonymized company that we're going to call Mars Corporation, and we've done a worked example on each of these steps through this webinar. So the very first one, Stuart, can you talk to me about this proactive NPE strategy?
Sure. So one of the first questions that we pose when thinking about an NPE risk or NPE threats is really, how many patents do NPEs actually own within my technology? And this is a difficult question to answer without a tool like Cipher that can go and skim through all of these patents and just select the ones that are related to you. So in this example, we've taken the 9% of patent families that Cipher has selected as relevant to Mars's technologies and highlighted them here in red. And we can see that most of those patents fall within wired networks and social media. Now, this is a great piece of information to know. It gives us an indication of the amount of risk or threat that we face. But to get a better idea, we should really pull in some litigation data. So on the right here, we've selected just those NPE patents that have previously been involved in some plaintiff litigation. And again, we've highlighted those relevant technologies here in red. So the key takeaway here, looking at both charts together, is that although only 9% of NPE patents are relevant to our technology, 44% of all litigations that take place from NPEs have been in our technology spaces. So this should really raise the alarm. It should indicate to us that NPE risk should be taken seriously within our sector, and that can inform our risk management strategy moving forwards.
Stu, if I can stop you there just to ask a question that's popped up. It's, does the detail stop there?
Sure, yeah, so that's a great question. This is a very high level view. So we're almost looking at all NPEs as if they were one organization. We've just got all of their patents together. Within Cipher, we can actually break this down. We can look at single NPEs. This could be an NPE that you've read about that you think might have some patents in your technology. We can identify that for you. We can also look at those NPEs that have, for example, the largest portfolios, or just the most litigation. We can sort on that, and we can really identify the riskiest portfolios for your business.
So I think if I'm understanding this, it's very, very likely that Mars will be litigated by an NPE. But the density of litigations in their technology is really, really high. So what does happen when you are litigated by an NPE? I think we always talk about this at Cipher of readiness and preparation. We've done the proactive step. Now it's time for the reactive step. It's about pulling out the rug underneath an NPE's legs to be able to respond to them very, very quickly, analyze everything they're trying to assert against you, and rationalize the conversation around a licensing agreement. Here, we've done this analysis for Intellectual Ventures, 4,500 patent family portfolio. And you can see in our example, only 8% is deeply relevant to our company. Another 17% is adjacent technologies. And then we've selected a couple of interesting categories using the universal technology taxonomy to sort of give a final polish on everything that could potentially be relevant out there for us. But the main takeaway is this overwhelming blue bit, which is 64% of the patents that they've asserted against us are unrelated, and then they shouldn't really be a factor in any discussions we have with an NPE. Nigel, you and I have used this a few times with real life examples. I'm sure they wouldn't mind sharing a couple of interesting times we've used this.
Yeah, no, I think I just wanted to go and reinforce the point that it's real. The example that you and I worked on most recently was 1,100 patents owned by an NPE asserted against an operating company, and they had a few claims charted patents. I think it was 3. So the logic goes, I have 3, therefore you must infringe all 1,100. Please take a license of 1,100. And the response was exactly this pie. And on analysis, it was 54 of the patents were even relevant. Forget validity and infringement, were even relevant. And I think whilst we smile because we know the outcome was positive in as much as the wind was taken out of their sails, it also showed, I think, rather markedly that sometimes the assertion entities don't understand their patents as well as we do, because the law of large numbers are really hard to analyze, and bluff and bluster is a decent substitute. So it works to get on the front foot, it works to achieve a better economic outcome.
That's fantastic. Thank you, Nigel. So I think summarizing, we've scoped our NPE threat. We also laid out a method for addressing it here. Now I want to hark back again to the report where 92% of respondents said the key to mitigating risk in IP is building a strong patent portfolio, and get into the meat of the webinar, which is really OPCO risk and how to mitigate it with the right size portfolio. Because of course, building a portfolio against an NPE is a little bit of a wasted exercise, but definitely not all companies face the OPCO, the NPE risk as largely as others. Our strategy for mitigating OPCO risk is similar. The same steps of scoping, classifying.
I put my hand up here, Casper. I was thinking of stockpiling it, but I've just got 2 questions on NPEs. Would you mind if I throw those into the mix before we move on to OPCOs? Yeah,
absolutely.
The first one, and actually they're quite similar. The first one is, how do you identify what's owned by an NPE? Is it Cipher or a third-party data provider? So it's mainly the former, but a bit of the latter. So we take a license of RPX NPE data, and we accept that categorization of NPEs, as many organizations around the world do. So that basically means we ingest the litigation data from another third-party organization, and then we tag it using NPE data. And obviously, as our knowledge grows, we also use additional information. But the second question, which is related to the first, is how confident are that we've covered all NPEs existing in the world? Well, that's partly a definitional point. There's a lot of discussion around our universities' NPEs, et cetera, et cetera. And again, we lean very heavily into the RPX definition. So we're confident that we track the RPX definition faithfully, but there's definitely around the edges some definitional issues. The second question is much harder, which is how do you keep track of reassignments and portfolio sales? So the answer is we do, and RPX make a living out of doing that. How confident are we? Well, there is a slight edge case, and we occasionally bump into it, whereby we don't know a company's an NPE. A new NPE is born, or a new subsidiary is born, and they buy 1, 2, or 5 assets from an operating company, because that's who's feeding the beast. And either the NPE won't record that assignment, in which case we're all in trouble, because how would we know? And they don't need to record it until they litigate it. Many don't record it, so we simply don't know about that unless there's been some press release, and often there's not. And then the second point is, if they do record it, but it's a name like Green Garden, it's not self-evident to RPX or to Cipher that Green Garden is an NPE, and they've got no known affiliation with an NPE. And of course, we don't read the share register of every single company that's ever formed in the world. So it's pretty comprehensive. I would say it's best in class. But are there errors? Well, welcome to patent analytics. There are errors and imperfections everywhere you look.
Thanks, Nigel. I was just going to jump in there also and to say it's a big data problem. None of the things we're presenting here are very easy to do for a human. Machine learning and classification make it much easier. I think the adoption of becoming comfortable with a certain amount of uncertainty is really important, whether that's uncertainty in capturing all NPEs, whether that's uncertainty in your patterns being valid. I think we have to accept that and not get frozen by it and be able to do the best proactive work we can with the tools and the data that we are given. So coming back to the real good stuff of this webinar, the operating company risk. This is where your portfolio being the right size and shape can really make a difference. Classifying your technologies, mapping to third-party owners, and refining from possible sources of risk are the most important steps you can take. A step that I also advise is knowing to map the right third-party owners. There is an awful lot of companies out there that are popping in all the time. I think intimately IP departments have an understanding of who their threats are, but it's always great to take a data-led approach and validate their assumptions, whether that you have the correct threat list, whether you have the right competitors, and Cipher's tools can help you do that. So we've done this approach for our Mars Corporation here, haven't we, Stuart?
Yes, so here we are looking to build that threat list that you were just talking about. What we've taken here is the landscape from the top 3 UTT classes that were relevant to Mars Corporation. This is just a way of finding the patents that are relevant to us within our technologies. We've assembled here the top 20 owners, a few more at the bottom, and this is a great starting point. It gives us an idea of the largest portfolios in our technologies. These are the portfolios that we should really be prepared against, because if they came to demand a license fee from us, for example, that would feature in a kind of in the red zone of our risk matrix. They're very large, very relevant portfolios. There might be some new companies in here that we haven't seen before, but chances are the IP department will be familiar with most of the names on this list. But we know that risk and technology are both dynamic. They change over time. So it's not enough for us to sit and be happy with our list of top 20 owners on the left there. So what we've taken here is a view of the top innovators within our technologies. We're measuring this by the number of patent families that they've published over the past 3 years. And we can see here that some different names jump out that were not featured in our top owners list. So for example, NTT feature as one of the top 20 innovators, but they don't feature in the top 20 on portfolio size alone. Amazon here is the inverse example. So they have a large portfolio in the top 20, but in recent years, they've been filing more. So they are actually in the top 4 in terms of families published, when they're only in the top 10 in number of patent families on the left.
So looking at this list, there's a lot of what I would call almost existential threats. If one of these companies comes knocking at your door, Mars, with your relatively meager portfolio, it might end badly. It's going to be difficult negotiating the position, and this list stretches a lot further down than just the top 25 owners that we're presenting here. So I think it's really important to take the time to build the right threat list, build the right set of competitors that you want to analyze. And part of our process here is classifying and high grading the threats you face using a triangulation of data. So it's really the portfolio size we've seen before, and then picking up to also propensity to litigate, so counting plaintiff litigations, and then also incorporating the fact that revenue can influence a company's IP behavior. They can go from a very defensive strategy normally, but if there is, for example, declining revenue, they will be put under pressure to monetize that portfolio, and they could switch from not being a plaintiff to actually aggressively looking to license their patent portfolio. So with this in mind, it's great to then map out all three of these data points and high grade that list into manageable tiers. Stuart, we've done this for Mars that we can see in the blue here, but you've got this threat matrix that you were describing just a little bit earlier.
That's right. So this is a typical example for something that we would look at with a client when we're building this tiered threat list that we're describing. So this visualization is really pulling together those three data points. Portfolio size being represented here by the size of the bubble. On the x-axis, we have revenue growth or revenue decline over the previous 3 years. And on the y-axis, we have plaintiff litigations that they've been involved in. If we start with an extreme example here, Mercury, just on the far right of the x-axis, we can see that they've had massive revenue growth in recent years, so 110% revenue growth. They've been involved in 0 plaintiff litigations, and they have a relatively small portfolio size compared to some of the other threats on the list. This means that we can comfortably move Mercury into our watch list. So we're still going to track them in the future. The revenue growth is indicating that they're likely to grow as a threat in the future, but we'll move them into our watch list. Our tier 2 threats are all grouped around Mars or just above Mars. They have a combination of these 3 factors, but it's not until we move across into the tier 1 threats here in the red that we see a real combination of all 3 of those risk factors, with history of plaintiff litigation, so perhaps appetite for enforcing their portfolio. They've had negative or middling revenue growth in recent years, and they also have, in the case of Jupiter and Neptune, much larger portfolios than Mars. So these threats we would high grade into the tier 1 threat list, where we're going to be building our defensive strategy as best we can to neutralize or to mitigate the threat that we face from these companies.
That's great, Stuart. And it's important to emphasize that this is not the only indicator that you can use, but it definitely tries to come up with a data-led approach to estimate where your threats might come from. Of course, any one of these names can one day wake up and say, you know, I want to monetize my portfolio. However, using this approach will at least make you comfortable with a probabilistic analysis of the most likely scenario to happen. I think tying in also the quantification of this risk here is important, because we can see those 2 massive planets in Jupiter and Neptune that pose a very significant risk to our Mars portfolio. How can we quantify that and become comfortable with it when it seems so huge? That's really where the optimization that Cipher deliver comes into its own. So to summarize the process so far, we've scoped our threats, we've classified the patent families, we've seen everything that reads onto our portfolio through the classification lens that Cipher provides. And the next step we've sort of introduced.
Can I put the blue pen up on behalf of the audience? Can we just go back 1 slide? I'm sorry, Casper, I'm trying to go and catch these as we go along, and I wasn't paying attention. But the question is, what about cross-licensing? So I think, Casper, you were pretty clear there that this propensity to litigate is super useful, but it's not the only way you can go and look at propensity to litigate. Clearly, if Mars had a cross-license, a non-assert agreement with Jupiter, then it's, well, however badly it's doing, it's not a threat. And there's a lot of other weighting factors. There are some very well-known companies on this call today who once upon a time used to regard IBM as a threat until IBM became the ultimate holding company, where clearly holding companies don't sue their subsidiaries. So we need to recognize that these kind of threat models that Casper's talking about are dynamic. They change all the time. They need to be revisited. This is not a one static moment in time. You need to keep on reviewing it, and your threat list will change.
Yeah, that's a great point. That's a great question too, and I think that also illustrates the relationship that we have with our clients. If this is a conversation that we have, this is, you name your threats, we analyze it, we also suggest, and together we come to conclusions based on data. And of course, you can tell us whether you have a license to a portfolio. Yeah, you can keep that completely secret to you. And the model that we're going to show you allows you to input your own data and make your own predictions without having to divulge anything to Cipher or throughout. So this model that I really want to get to, we've classified the relevant patents. I think that's sort of well understood now how classification is really such a time saver. And how amazing it is for giving you a lens. Next, we're introducing this mapped revenue piece. So this is trying to estimate how much revenue might be at risk in case of litigation, and it's looking to rationalize the conversation in cross-licensing. If you might be dwarfed by a portfolio, but how does your revenue in a product area correspond to theirs? And that is really the heart of the Cipher optimization model that allows us to estimate the revenue at risk and how real the threat you face is. So carrying on with our example, this is the very beginning of it, and Stuart, you are able to talk about this far more eloquently than I can.
Sure. So what we're looking at here very simply are the inputs and the outputs of Cipher's portfolio optimization model. All of the detail in the calculation have been laid out in some previous pieces that we've published with IAM, but we'll start from the top left here. We have just the number of active patent families that have been mapped for social media for the 3 companies that we've identified as a threat within social media. Below that, we have this mapped revenue figure, again, just for the social media technology. Combining this with an assumed royalty rate, we're able to actually quantify the risk materiality, that is the revenue at risk, against each of these competitors. And we've presented that on the right here. And we can see that since with Mercury's, the example of Mercury, they have a relatively small portfolio compared to Saturn, for example, but they're protecting much more revenue with that patent portfolio than Mars are protecting. These factors combine to give us a positive revenue at risk against Mercury, which indicates that we are within social media slightly overbalanced in our portfolio against Mercury. The opposite is true for Saturn. So we have some revenue at risk against Saturn, but combining those 2 figures, we've calculated that there's no revenue at risk overall within this technology. Now,
or is very slight. I'm just going to point out it's very slight, so it's not on the scale of millions. I think the Excel shows it around $180,000 negative position towards Saturn in this case. But I think you were about to say we're going to click this through all the way to the 3 technology areas that we've mapped and also all the threats we've identified.
That's right. So clicking through here, we can see this risk materiality calculation repeated for each technology area and each competitor on our threat list. And this allows us to see that sum of revenue at risk against the threat list. And it also allows us to see whether we're over or understocked against specific competitors on that threat list. This allows us to really target any changes that we might make to our portfolio by modeling what a balanced portfolio would actually look like against our threat list.
So this approach, I think, is quite important because it not only balances your risk, but also identifies areas where you have opportunity either to monetize or perhaps prune. It's not all take. The aim is to build the most rounded and balanced portfolio. But I think the example we're working through here, we've addressed Mars's NPE situation. We've seen that the NPE risk is very real. we've scoped some quite existential threats in terms of operating companies that Mars can come up against, and we've quantified the risk against them to be this estimated figure of 37 million US dollars. One caveat here I want to point out is that your risk in all technologies versus a competitor is not the same. So, for example, within social media against, let's say, Venus, you might be in a positive situation, so there is no risk materiality to you. But that analysis can be done at the right level. I think this model is great because it can translate a company's IP strategy not only to the C-level, but also through to your portfolio managers, business units. You can feed them the data that they need to make the right data-led decisions within this. I think another question that it answers is really easily as well. You've done this analysis for Mars, and as a company, we're still facing $37 million of risk. What's the point of having a patent portfolio in the first place? And we can model that scenario of what would happen if Mars had 0 patents to protect all of their revenue. And you can see how those numbers change in terms of the risk materiality. Becomes significantly larger. Your risk materiality has now ballooned up to 62 million, and your net position across everybody on your threat list is in the red here. So it's worth pointing that out as well, that it can demonstrate to your GC, to your board as well, why having an IP strategy and a right-sized portfolio is so important. Nigel, did you have any thoughts on this?
I had a blue pen from the audience, which is someone who's obviously been following our webinar series, who asks, what's the connection between this and return on investment? Okay, so shout out for Jeremiah Chan at Meta, who co-authored a paper with us, or sorry, we co-authored a paper with him last year called Calculating the ROI of Patents. And there is some overlap. I mean, we started our work, I don't know, 5-6 years ago with optimization, where we were trying to answer the foundational question, how many patents are enough? And it's morphed and developed into this risk solutions group at Cipher, which is saying that one of the benefits of a patent portfolio is risk mitigation, and we're trying to quantify it. That returning it to 0 is an ROI calculation. Okay, there's still 37 million of risk, but your portfolio, as it stands today, leave aside how we might go on to talk about mitigation, your portfolio as it stands today reduces that risk from 62 to 37. So if I was amazing at maths, you would be able to go and articulate, wouldn't I, Casper, what the risk mitigated by the existing portfolio was today?
That's right. That's right. It'd be on the scale of 25 million US dollars for this particular example.
And you can go and work out what the cost is, and the ROI paper basically says return on investment, whilst it might sound like a novel concept for IP professionals, only has 2 numbers in it. One is return, and the other is investment. And return is another word for the benefit. So the benefit is the amount of risk which is mitigated, and the investment, of course, is the cost of building the portfolio. We might get on to talk about patent acquisition plus the cost of patent acquisition.
Yeah. And I think it's important to emphasize we need to carry on to that 4th step. Doing all this and sitting on this information, I think is not the right approach. The final step really should be communication of this risk. I think the optimization that we've performed here, the modeling of optimization we've performed here, because we haven't optimized our portfolio yet, is really important to communicate. And I think the tools that Cipher can provide are great at allowing you to do that and have the reach throughout the company to explain something with real terms, with real numbers, and not an abstract idea of we might face some patent risk somewhere down the line. So coming on to this mitigating patent risk, I think this is great as well, because it allows you to sort of war game your portfolio in such a way, and then also introduces this idea of the return on investment that you'd be able to calculate. So what we've done here is we've tweaked the Mars portfolio. We've increased across the 3 areas because we were severely underbalanced, and we've also propagated that to an increase in cost for your portfolio. Of course, we can't discount that patents cost money, whether that's filing them, upkeeping them, buying them, etc. But this waterfall chart communicates this really clearly. We're going to ask for an increase in $3.1 million, and we're predicting to reduce our risk by $14.3 million. Nigel, you've been in a hell of a lot more boardrooms than I have. This is something that a board can understand. This is tangible to them. Numbers are great, and there's action here that they can take, right?
Sorry, on mute, my own mistake. I mean, yes, it's clear. I mean, I think it's moving it to numbers rather than hand waving. There's quite a lot of patent strategy that is, or at least has been, managed by gut feel and experience. And I'm not diminishing either of those things, but these are numbers. I don't think when you say the word predicting, you're modeling. You're saying the impact of putting those 3.1 million, you're not just saying 3.1 million of patents, you're actually putting them in areas which on the model diminishes the risk. And probably a good time to read out what is quite a long question in the chat. So I'll try and summarize, and if I don't, the person who asked the question can call me out. But it says, a portfolio with a lot of revenue, dependent on a few families, is riskier than a portfolio with revenue distributed across more families, ? And of course, that's the point. The portfolio optimization paper we published in, I'm getting old now, but I think it was around about 2017, said the foundational calculation, which is endorsed by recent court judgments, then and following, is that risk is P times R, or at least your portfolio read against the revenue of somebody on your threat list, compared to the portfolio of a third party read against your revenue in that area. Now, that's a delta, and I think Stuart did a really good job of trying to bring that down to the base case of one or two companies and one technology. The reason why the economic model is required is because you could be overstocked or understocked against one company, but balanced out by the converse position. And of course, you have a lot of companies. You might well have a negative position against one company, but in the round, you're balanced out by companies where you're positive. Now, I know that has some imperfections. It means that if you are unlucky and only those companies who have a dominant position over you come after you, then you might well still be the net paying party. But we need to deal with realities. I really like these numbers that you've chosen, Casper Stuart, and these slides. You're asking for 3.1 million in order to get a return on investment and mitigate 14.3 million of risk. The only way you can get the risk to zero, well, maybe I should ask that question to you, Casper. There's people on this call who are not enjoying residual risk. Can you please recommend a strategy for eliminating risk to zero?
Yeah, I mean, in an ideal world, of course, we'd have unlimited budgets, and we could go and buy all the possible patents that are out there that might read onto our portfolio and protect ourselves that way. I don't think that's a very prudent strategy in terms of the return on investment. I think you have to be comfortable with balancing your risk with also opportunity. As we've sort of alluded to, there are areas of green, and whether that's pruning or monetizing, you can seek to use that in your favor. It's not always all take. And I think it's important to be comfortable with deciding where on this risk spectrum you're happy to be. Maybe this is a perfectly fine position for Mars to be in, because the company might want to take a different strategy. I mean, another way is to simply stop making revenue, right, Nigel, and just protect yourself that way. So there's nothing for your competitors to go after.
And I know all that sounds quite like jokey banter, but I do think I wanted to make the point that the boardroom isn't about risk elimination. This webinar, this solutions group is about mitigation, and businesses are about risk. And if you don't want to take risk, then don't be in business. So we're only looking to go and get the appropriate amount of investment to reduce the appropriate amount of risk.
And I want to make the point here as well that this is not the maximum amount of revenue protected. This is actually the minimum amount of revenue that you protect with your portfolio, because in our worked example, we've only done this for a dozen or so companies. Of course, there's everybody else out there that your portfolio protects against. So this ROI figure here on the right, this 14 million is again the minimum amount. But it illustrates the point, at least for this particular example, that it's important to be good custodians of your company and invest in risk prevention, because it's quite severe. For the Mars example, we've done this analysis for other clients where actually it's the return on investment is more like 1-to-1, where actually it might make sense to save money and prune some patterns because your portfolio is in actually great shape and tip-top shape. And what a wonderful conclusion to come from this modeling, to say, hey, we've been very good with our money. Our portfolio is really right-sized, and we can actually look to save our company costs as well. I think I want to sum up, because there is quite a lot that we've gone through, but this approach of 1, 2, 3, 4, the scope, classify, quantify, and communicate risk is I think a very approachable model, and it heavily relies on the technology taxonomy and also our desk-based research of revenue mapping that we've introduced here.
So some time for more questions, Casper?
I think we are looking quite good. I make it 49 minutes so far.
Perfect. Well, there's a few, so we'll see how many we get through. The first one is this slideware, or is there a model behind this?
Yeah, that's a great question. There is most definitely a model behind this. If you give me 1 second, I can put this up on the screen here. I'm just going to work through this, I think, from the top, because I think it's worth doing, especially if this is your first time seeing it. We have this, you know, in fact, I'm going to add in, let's say, cloud as well here, our cloud competitors. So this is the Cipher portfolio optimization tool. We build in this dashboard to be flexible to you, to make all the numbers read through and allow you to interrogate them fully. And I think there's great scope for optimizing your portfolio in this way. Walking through the steps here, we've mapped we've classified the pan families, we've mapped the revenue here for these companies, and then we've also assessed our net position against our set of portfolios and threats, and we've come to this sum of revenue at risk scenario. We can of course turn this all the way to 11 here, clicking all of our threats on. We come out to the familiar figure of $37 million against these companies, and summarizes your risk really neatly. There's the switch that I like to flick of what happens if we don't have any patterns at all. We get the numbers. And the last one, before I stop clicking around madly, is the scenario analysis, which I think is really great, and it allows you to present your strategy quite clearly. So we might want to increase our holdings in some of these pan areas, and model what our future capacity for risk mitigation might be. So again, we're seeing this annual cost increase, and you can tweak this really to your heart's desire. There's of course other inputs like aggressiveness factors, pan quality, such as our portfolio value index as well.
It's a really important point that this is about evidence-based decisions. The mantra of Cipher is evidence-based decisions. I don't think you're saying, Casper, that this is what you sit in front of the C-suite clicking. What it goes and says is you can model it. You can update the model all the time with the changing situation, and you can model it. What if? And I think that ability to do what if analysis in a live model is one of the things that I find so powerful. So thank you for that. I think this next question is at you, Stuart. It was, you had some metrics looking at the size of portfolio, then you were doing some growth 2018 to 2021. The question is, are they the metrics that you rely on, or are there others?
Okay, those metrics that we looked at were just the ones that we selected today, based on the subscriber that we're working with, the business that they operate, the industry they operate within. We would tailor the selection of metrics based on that. So if new entrants were particularly concerning, if that's something that we need to spot in our risk strategy, we have metrics like new entrants where we're just looking at the most recent filings where a company has filed in our space for the first time, and we can really focus in on things like that. So there's a whole suite of metrics that we can choose from when building these types of insights.
And if people are wondering what metrics are best for what situation, a previous report, which I think we've put into the handout, is a benchmarking report. Yeah, I see it there. If you want to download it, I think the top 4 metrics were age, geography, obviously a size metric, and a couple of others. I think quality was in there as well, what Stuart just referred to as PBIX. So, but we don't necessarily, I mean, that control has to be your position. If you know that there was a certain time range where all the foundational technology was created, and you find one of the threat lists that happens to be deep into patents granted in that or filed for in that time zone, then you might give it a different weighting. Equally, if you're not trading in China and one of your threat lists only has Chinese assets, then possibly that threat would be downweighted until such time as you moved into that geography. So I think the fact that Cipher strategic patent intelligence platforms have all of these data points available, but clearly we couldn't go and demonstrate all of that today. And I think the 2 you selected, Stu, were a reasonable proxy for things that might create greater risk. The next question, we've got time for a couple more. Okay, Casper. All models are wrong, and this approach appears to be driven by counting patents. Isn't that too crude?
Yeah, that's a great question. A little bit tricky, right? But I think it's becoming comfortable with a certain amount of uncertainty. Unless we have a very large patent department, we can't possibly scan every patent in the world, nor do we have unlimited computing power. But I think it's leaning towards the probabilistic nature of patents. You want to be right more often than you're wrong, and I think the Cipher data is definitely crucial in doing that, setting yourself up for success, making the best decisions you possibly can. And yeah, I think fundamentally all models are wrong. Some of them are useful, and I think you wanna have a model that you can interrogate down the line and say, what were the assumptions that we made? One of the assumptions that is heavy in this is the idea of revenue mapping. You know, we get this all the time. How can you revenue map accurately? I mean, so back in the day, a company would clearly lay out exactly how much revenue they made from building cars and how much of each component of that car contributed to that revenue figure. Nowadays, I think technology is so interwoven with each other that you need to be comfortable with a certain amount of tolerance, and you need to use the best possible data you have with you to make data-led decisions down the line, regardless of not stopping yourself from doing this analysis just because you think the data's not out there. I can assure you the data is there if you look for it.
Cool. I promised to make sure we didn't run over time, so we've got 5 minutes remaining. So quite a lot of ground covered. Thank you, Casper. Thank you, Stuart. Now you've got the unenviable task of trying to give some key takeaways to the listeners. What message would you like to deliver? Start with you, Stuart.
I think my key takeaway lines up quite nicely with what Casper was just describing, that although this can seem complex, we had a quick look there at the portfolio optimization dashboard, lots of options, lots of visualizations there. The idea behind it is very simple, and once you get your kind of understanding of, once you become comfortable with that model, Cipher does all of the heavy lifting of counting patents and mapping revenue in collaboration with you, of course. So that's the key takeaway for me. Once you're comfortable with the model, the insights that you can get from this are really valuable.
Thanks, Stuart. Casper?
I think we've made such a leap in fast and reliable classification. It's now, there's no excuse for IP departments not to address risk head on. I think they should own it. They should be custodians of risk within their companies. They should communicate it and really be crucial players in protecting their company's success with intellectual property. This mode of firefighting all the time, I think, should switch quite heavily to preventative measure. How can I be best placed to protect my company from future risk?
I think that's brilliant. Sadly, Casper, you've probably done my key takeaway, which is a little bit disappointing. People might get their tea or breakfast or lunch a little bit early. But the stat which I started with, this idea of 56% of organizations only report risk when there's a problem, that's the thing we want to change. There is masses of evidence, not only in the IP field, but elsewhere, that reactive risk management always costs more. Always costs more. You're under pressure, you're panicking, you haven't got time to assess, but preventative measures, mitigation strategies, just allow all of those kind of safety measures to be put in place. I'd encourage you all to consider whether what we've discussed today inspires you to communicate more openly, more regularly, more evidence-backed. But for now, we're grateful for your time. Casper, huge thanks to you, Stuart, and to the marketing team at Cipher, in particular, Georgia, for making all this happen. Goodbye.